want to welcome everyone to the video for retained earnings, and then with next one we'll do earnings per share. This one's going to be dealing a lot with both cash dividends and stock dividends and how they differ, along with paying dividends to preferred shares and common shares and how you have to account for that. Okay. First thing we have is there's 4 dates we have to have, okay, on the dividends. There's the date of declaration, also known as the declaration date. That requires a journal entry, and this is the date that the dividend is declared. Then we have the ex-dividend date. On the ex-dividend date, this is the stock before this date, after the declaration date, but before the ex-dividend date, the stock will have, the price of the stock will basically include the dividend. There's no entry for that. After the ex-dividend date, then the stock loses the dividend. And then we have the date of record. And the date of record doesn't require a journal entry, but it requires a memo. And this is the date that the board of directors has said, as of this date, these are the stockholders that will receive the dividend. And then, of course, the other date that's important is the date of payment. And that, of course, is the date that the company sends out the dividend. Okay, so for the example we're going to have, on October 6th, 2017, Bagel Corporation declared a $25,000 dividend to preferred stockholders and a $35,000 cash dividend to common stockholders. The dividends are to be paid December 16th to shareholders of record November 30th, 2017. Okay, so we'll make that 2017. Missed the one. Okay, so on the date of declaration is our journal entry. So on that date, we will debit retained earnings. Now, when you declare, this is given to us, so we have, if you want to equal the $25,000 plus $35,000, or a total of $60,000. Okay, this time we told us what the dividends were. Then we would have dividends payable for the preferred stockholders, and that was for $25,000. And then we have dividends payable for the common stockholders, and that's for the $35,000. Okay, so that's our entry when we date the date of declaration. Debit retained. Now, some places instead of retained earnings, they may say dividends, dividends payable, or not dividends payable, dividends declared instead of retained earnings. Then, if they do that, dividends declared would be closed into retained earnings at year end. Okay, or you can go directly into retained earnings. All right, dividends payable, preferred stock. Preferred stockholders get their fair share first, then the common stock. So both of them are getting their stock. Date of the ex-dividend date, we don't have to worry about that because that's just the date that we don't have any entry for. But on November 30th, that was the shareholders of record. That's when we have a memo. And on that one, we have memorandum entry. The company will pay dividends on December 16th of 2017 to shareholders of record of today, the date of record. Okay, that takes care of that. And then December 16th, of course, is when the shareholders interested. That's the date of payment. So we would debit dividends payable payable for the preferred stockholders, and that's the $25,000. And then we have dividends payable for the common stockholders. That's for $35,000, and of course what you pay it with is the cash account, which totals the $60,000. Okay, that is the date of payment. Okay. Now, preferred stock can be a little more complicated than that. It can be participating or non-participating. If it's participating, okay, and then if it's participating, it can be fully participating or partially participating. First one we're going to do is fully participating. So we have Bagel Corporation issued 250 shares of 8% preferred stock at $50 par value. The company had 12,500 shares of $2 par value common stock that was issued and outstanding, we're going to say, and Bagel Corporation declared cash dividends a total of $9,000. So we have to say, how are they going to be doing this? Okay, so the total par value of the preferred stock, well, it was 250 shares times $50 a share, or $12,500. The par value of the common stock was equal to 12,500 shares, and it was at $2 for a total of $25,000, which gives you a total of $37,500. Okay, now, what we have with this, we want a percentage of total. What percent do these contribute to the total par value? So to do that, we would take equal the 12,500 divided by 37.5, which is 33/3. Actually, it's 1/3. And this one is 25,000 divided by 37,500, which is 67%, which is actually 2/3, because that's what it actually is. Okay. Now, for the preferred stock, what we have here, preferred stock gets their percentage first. So they have equal. They have how many shares? Well, we could actually take the par value 12,500 times 0.08, or $1,000. Common stock also gets 8% because it's equally participating, 0.08. So they get $2,000. Okay, so you have to see how I did that. Took the par value, 12,500 times the 8%, because that means they get 8% of par value for the preferred, for the stock. And then since it's participating, common also gets 8% of their stock. Okay. Now, fully participating, they receive 1/3 of the balance. We have a total of $3,000 that we have used. So we had a total of $9,000 that was declared, minus the $3,000 times 1/3, or they get an extra $2,000. For common, we do the same thing. Equal, they have 9,000, forgot the parenthesis, equal 9,000 minus the 3,000 times they get 2/3 of it, or $4,000. So they get a total, preferred stock is going to receive a total of $3,000, and common is going to receive a total dividend of $6,000. Whoops, let's try this again. Equal, got to add everything up, don't we? Okay, $3,000, and common is going to get a total of $6,000. So that's how you do, that's if it's fully participating. For partial participation, we have, I'm going to divide this up a little bit so you can see there's a difference here. This is they're going to participate up to an additional, up to 10%. So they get 8% to start with. So this will be calculated the same way we did before, the 12,000 times the 0.08. And this is going to be equal to the 25,000 times the 0.08. Okay. Now, they only get an additional 2%, provided we have it. So we have, they get it equal. We would have the 12,500 times 0.02. And they would get then the equal, the same thing, the 25,000 times 0.02, because they get a share equal, and we have enough in there, so they get both of it. Okay. Then common receives the balance. So they have equal to 9,000 minus the 3,000 that we had, minus the 750, which is the 250 plus the 500. Those two added together. Okay. So they get an extra 5,250. So the common then, since it's an additional only 10, up to 10%, Preferred stock will actually receive a dividend of, let's try this again. I got too far down. Of $12.50, and they will receive a dividend of $77.50. Okay. That is on the earnings per share. Next section we're going to do is property dividends, and I think I'm going to wait on that one.